Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Some of the stories now that we're tracking for you in the BNN Bloomberg newsroom. Let's have a look. Ahead of tomorrow's spring economic update, Prime Minister Mark Carney announcing Canada's first ever sovereign wealth fund. Carney says the fund will receive a $25 billion endowment and will operate independently from the government. Here's the Prime Minister outlining the plan.
Today, we're proud to announce a new pillar of our plan, the Canada Strong Fund, Canada's first national sovereign wealth fund. This will be a Government of Canada fund, but more importantly, this will be a people's fund. It will be your fund.
Shares of Domino Pizza are down about almost 9% right now after missing on earnings for the first quarter. The decline was due primarily to a $30 million loss from its investment in DCP Dash, a food delivery service that relied on independent contractors rather than in-store employees. Despite the results, the company remains positive, citing its scale advantage and its relative resilience as the broader restaurant sector comes under pressure. We have a major deal this morning in Canada's energy sector. ARC Resources is being taken over by Shell in a deal valued at $22 billion, including assumed debt. Shell says the transaction strengthens its integrated gas business and expands its footprint in Canada through ARC's Montney assets. The offer is a mix of cash and stock, represents a 27% premium in ARC's most recent trading price. And a quick boo at the markets right now. You can see TSX slipping a little more. It's down by 0.29%, being dragged down by the materials, consumer discretionary spending. Those are the ones taking a hit today, but most are in the red right now. Energy on the plus side. And south of the border, similar situation. Everybody's down across the board after the rally we've been going on. S&P 500 up by 0.13, Dow by 0.29, and the NASDAQ about the same. Yeah, it looks like North American markets taking a bit of a breather this morning after efforts to resume talks between the U.S. and Iran stalled over the weekend. All this comes as 5 of the Mag 7 companies are set to report their earnings this week, midweek. Together, Apple, Alphabet, Microsoft, Meta, and Amazon make up about a quarter of the S&P 500. Their earnings will be a crucial test of whether today's near-record market valuations can hold. Let's get more now from Eric Sterner, CIO at Apollon. Eric, thanks very much for joining us today. You remain bullish.
Yes, I do, and thanks, Roger, for having me. The first quarter earnings season is looking to be outstanding. I mean, right now it's projected S&P 500 companies are projected to grow earnings by 15%, which would be the 6th straight quarter of double-digit earnings growth. And the net profit margins are near 13%, which is as best since 2009. I certainly think we have some tail risk, of course, with the Middle East conflict. I think the market is betting that this conflict is de-escalating, but certainly we continue to see some mixed messages coming out of the Middle East and the Straits of Hormuz. So that's something that investors should pay attention to. But from a fundamental perspective, the earnings are looking very strong for the S&P 500 companies.
All right, I want to talk about that in just 1 second. I just want to finish with the Middle East. So it does feel like there's less and less reaction every time a delay or a snag like this weekend. We saw another, but then all of a sudden they're meeting with Pakistani officials. Iranian officials are meeting with Pakistani officials. But it seems to be less and less of a reaction from the market every time.
Yeah, I think for a few reasons. One, the White House this is a midterm year, and this is not a popular war here within the U.S. And there's affordability concerns amongst many households, especially now with the cost of living being up 25-30% since COVID. Now we have higher gas prices and potentially higher food prices as a result of these higher diesel prices, even fertilizer prices continuing to escalate in the near future if the Strait of Hormuz is not normalized. So I think investors are betting that the White House has a major motivation to put this war behind them. But certainly that remains to be seen. And if the Strait of Hormuz is not reopened and normalized soon, then that could really cause some more upward pressure on inflation, which could cause some major concerns from the White House as midterms come up in November later this year.
All right, and let's talk about the earnings. And hopefully get back to the election. But earnings right now, mentioned it's been good. I think last time I saw 80 or 90% above. How important are the ones we're going to see on Wednesday?
Yeah, well, I mean, it's interesting because in the first 2 months of this year, we were starting to see a market rotation, and technology was actually the second worst performing sector for the first 2 months of this year because of concerns about their valuations. But the NASDAQ 100's PE ratios have dropped 23% from October to the beginning of or the end of beginning of March. So that helped reignite some of this AI rally, and we're certainly seeing strong rallies in technology, especially semiconductors. And we know the Magnificent Seven is right in the middle and the engine of this AI, especially NVIDIA, who we have to wait a little bit longer for earnings. So it will have a major impact on whether this rally can continue as we hear more from the Magnificent Seven this week. I expect to hear continued strong earnings from those companies, and I think this rally still has plenty of legs to it.
All right, we got a Fed decision on Wednesday as well. It's a busy day on Wednesday. What are you thinking we're going to see there?
Oh, I think it's a sure bet. We're not going to see any rate movements. It'll be interesting to hear what the Fed has to say about their projections of rate cuts for the remainder of the year. But of course, the big variable is what's happening in the Middle East and when that will be normalized. So it's hard for really the Fed to have any opinion there when no one knows when this war will be, the ceasefire, a permanent ceasefire will be put in place. Of course, a big question on many people's minds now that the criminal investigation probe has been dropped for Jerome Powell. Will he continue to stay on the board, even though his chairmanship is over come May 15th? So we'll see if he gives any indication of his future plans. But so that will be really what I'm listening to if Jerome Powell gives us any indication there.
All right. If I were him, I might want to go golfing. Top sectors you're liking right now. First up, healthcare.
Yeah, I mean, healthcare has really we haven't seen strong healthcare returns in a while, and it's one of the worst performing sectors so far this year. But we see healthcare in midterm years. In fact, the last 10 years, it has not beat the S&P 500. In 8 of those years, the 2 years it did beat the S&P 500 were midterm years. So it speaks to its defensive characteristics. But I think we've seen so many sectors catch wind of the tailwinds of this AI revolution, whether it's utilities, materials, industrials. I think healthcare is next because we saw an agreement not that long ago between Novo and OpenAI to help speed up the drug discovery. So I think there's a lot of potential tailwinds once we apply AI to healthcare. And also from an M&A perspective, I think we're going to see a lot more M&A activity within healthcare as a lot of these pharmaceutical companies are trying to fill up their pipeline.
All right, financials. We saw the banks early in the earnings season. Good numbers from most of them. How are you're liking financial?
Yeah, and that speaks to also just I think we're going to see some more M&A activity as interest rates have dropped since last year, and we see deregulation happening across the U.S. I mean, there are projections that we could see up to $160 billion in M&A activity this year. And I think the consumer at an aggregate level is healthy. It's a very bifurcated story. The higher end consumer is doing very well because of all the appreciation of home values in the stock market. The lower end consumer is struggling at the higher cost of living. By the aggregate level, the consumers continue to spend, and that helps the banks. And I think as we see more M&A activity this year and more trading activity, again, that'll help the banks' bottom lines as well.
All right, we got to wrap it up there, Eric, but thanks as always for joining us.
Oh, thanks for having me, Roger.
Eric Sterner, CIO at Apollon Wealth Management. Apollon Wealth Management, my apologies. Coming up, ahead of important trade talks with the U.S., Prime Minister Mark Carney has formed a 24-member advisory committee. More on that when we come back. The federal government is reshaping its relationship with the U.S. as Prime Minister Mark Carney launches a new Canada-U.S. Economic Advisory Committee ahead of CUSMA talks. For more on it, we were joined earlier by Drew Fagan, professor at the Munk School of Global Affairs at the University of Toronto.
This was done during the original free trade negotiations in various ways. NAFTA, the CUSMA negotiation, negotiating with Canada and Canadian negotiating stances are complicated. It's a regional economy, the power of the provinces and our federal structure. This is really the senior advisory committee made up of, interestingly and importantly, some ex-conservative politicians as well as business interests. And there will be other sectoral organizations as well as the government really gets down to work with the White House.
How much of what's going on back and forth between the U.S. before negotiations even start is playing a role, and what would be considered a success come summer? Well,
there's a sort of a deadline of July 1st. The language in the original agreement isn't very clear on the review. That's the official word of CUSMA, the USMCA, 6 years after it was signed. It's unlikely that there will be an agreement by then, given the timing. We're already at the end of April, and the complicated structure of negotiations among the three countries, which took place to some extent in the previous negotiation, 2018. Right now, the U.S. and Mexico are talking more than the United States and Canada are talking, let alone the more typical trilateral negotiation among the three parties. There's a lot of rhetoric being thrown around, particularly from the White House, the Commerce Secretary insulting Canada last week. So the Canadian side has tried to hold back a little bit, but reports are that the engagement is now increasing. I would expect later in the summer, there'll have to be some sort of statement by July 1st, but later in the summer into the early fall, we'll have a better sense of what an agreement, assuming there is one, and I think there likely will be, is going to look like.
And how much of an impact is Trump having on the actual negotiations that are happening behind closed doors that we don't really hear much about? Is what he's saying publicly, is that carrying down, or are they being more realistic?
Well, at the working level, which is the senior working level, the chief negotiator, Janice Charette, the ambassador of the United States, Mark Wiseman, I think that is sort of discounted to a certain extent. But when you also have the Commerce Secretary making the kind of comments he's making, let alone the president, that does roil the waters a little bit. And you saw the Prime Minister say last week, the rhetoric is unhelpful, or words to that effect. Let's get down to business here. And Canada does have cards to play, and that frustrates the United States, I think in part because the Mexican government is definitely looking to do a deal faster than Canada is. Because I think we see ourselves as, one, politically, it's difficult for the Prime Minister to make a deal quickly because it'll look like he's rolled over. And secondly, because we think reasonably that we have, as I say, more cards to play in terms of critical minerals, in terms of energy, in terms of other sectors as well.
The U.S., after the Supreme Court announced the tariffs were illegal, they initiated a review under Section 122 which has a deadline of July 23rd. Does that get looped into these negotiations at all?
Officially, no. Unofficially, yes. So you see, including in the announcement of this advisory committee, kind of the headline is sort of, don't forget that somewhere close to 90% of all our exports still go into the United States tariff-free. We've got the best deal in the world with regard to that. Well, okay, thanks, but we were supposed to have free trade, and we never really had it completely. We certainly don't have it now, given that there's any tariffs. So that is a factor, and the challenge in many ways is what success looks like, as it always is. The government is still saying that success would be, and we hope that the tariffs are off entirely. At the same time, well, they really have sort of given up that a little bit lately and said, we do expect tariffs to continue. They want to get them down. They want to minimize them. And Trump still talks like the tariff man. And it's hard to do what is supposed to be titularly, at least, a free trade agreement when you don't even have a complete elimination of tariffs. So at the end of the day, we're probably going to have a deal, say, in the fall. And there is a political question as to whether you try to delay until after the midterms election in November, given that the Republicans may stop controlling Congress at that point. The deal that you have to sell is to the Canadian public is probably not going to be as good a deal as we had previously. And you can see the Canadian government sort of preparing for that. We are playing some degree of defense, but at the same time, as I said, we do have cards to play, which is the reason why we're going to play this out.
I just want to bring it back to the committee. Is this committee? It's quite diverse, as you mentioned. There's a couple of conservatives, former conservative leader on there. Is this too big a tent? I mean, Carney has made that his kind of feature that he's got a big tent going on there. And could it devolve down into infighting, do you think? And could that have an impact on how the U.S. perceives Canada?
There may well be infighting once the government gets down to what kind of concessions it has to make. Supply management is one obvious one, probably be in the Canadian public interest, at least consumers, but significant politically. So, yes, there are diverse interests at the table. I don't think they'll be fighting amongst each other, but they will put forward to the minister responsible, Dominic LeBlanc, the position of the sectors they represent. And all major sectors are represented. There's no question about that, as well as the Prime Minister seeks some degree of national unity. As you noted, a couple of senior and respected conservative leaders and cabinet ministers. So you've got a big tent. The challenge with a big tent is a lot of people want to talk. I think that's a price worth paying.
That was Drew Fagan, professor at the Munk School of Global Affairs at the University of Toronto. Coming up, today's market driver is with Bloomberg's Monique Malima. Time to take a look at today's market movers, and for that we're joined by Bloomberg Equities reporter Monique Malima. Monique, thank you as always for joining us. First up, Nutrien. What's going on with them?
Nutrien, their shares are trading higher this morning after Barclays upgraded the stock to overweight. They see continued strong pricing in the fertilizer market because of the war in Iran. We've seen ammonia prices and potash prices to a certain degree already move up higher because of the tightened supply out of the Middle East. And although there is currently a ceasefire, analysts at Barclays say that they think the disruptions in the Middle East are going to continue to weigh on the fertilizer market. So for producers like Nutrien that have their supply outside of this region, they're able to capitalize on those higher prices and also see some higher demand. And that's why they say that they see a strong outlook for the company in the near term. All
right. And Baker Hughes, they're getting a note as well, aren't they? Barclays I just lost who was going. I'm going to steal your story. You do it.
So Baker Hughes, they actually got quite a number of notes this morning. We had, I think, over 7 analysts raise their price targets on the company. So analysts are really positive on the outlook for this firm. They reported their results last week and saw really limited impacts from the war in the Middle East compared to their peers. So that was something that analysts have been really positive on, that the company has been able to maintain its strong margins even with some of this disruption to operations. And they also note that even with the strength they're showing right now, with the ongoing war, that they're actually expected to benefit when the war does come to an end. They're in the oilfield services business, and they note that when this war ends, the Middle East operations for oil and gas companies will have to come back online. They might have to do some work to do that, and they'll need oil field service providers like Baker Hughes to do this. So they see a strong outlook for the company regardless of how things turn out.
All right, and we'll stay on the oil theme, HMH.
Yes, so HMH, their shares hit a record high today after analysts initiated coverage on this oil field service company and drilling company. They had their IPO earlier this month, and their shares had only been trading less than 1% up from their IPO, but they're now getting a big boost today. Analysts are really positive on recovery for the drilling space. They have seen some weakness due to the disruptions in the Middle East, but they expect that once this war ends, that the market will come back and also come back stronger. They think that companies are going to put more investment into drilling because they'll need to recoup some of those losses. And they also think in general, with kind of the focus that the war has put on energy, that there's going to be more demand for energy security and possibly for like stockpiling energy, and companies like HMH will be poised to benefit once that happens, even if there's a bit of weakness right now.
Okay, we'll wrap it up on that note there. Monique, thanks as always for joining us. Bloomberg's Monique Malima. Coming up, Shell has announced it's acquiring Canada's ARC Resources in its biggest deal in more than a decade. We'll break it down for you, what it could mean for Canada's energy landscape after the break. Ahead of tomorrow's spring economic update, Prime Minister Mark Carney announcing Canada's first ever sovereign wealth fund. Carney says the fund will receive a $25 billion endowment and will operate independently from the government. Here's the Prime Minister outlining the plan.
Today, we're proud to announce a new pillar of our plan, the Canada Strong Fund, Canada's first national sovereign wealth fund. This will be a Government of Canada fund, but more importantly, this will be a people's fund. It will be your fund.
Shell has agreed to buy ARC Resources in a deal valued at $22 billion. Shell says the transaction strengthens its integrated gas business and expands its footprint in Canada through ARC's Montney assets. What's up right now? ARC is up 22% right now. The deal represents a 27% premium on shares as ARC Resources is set to close in the second half of 2029. Elon Musk and OpenAI CEO Sam Altman head to court today as their legal dispute over artificial intelligence gets underway. It probably will get nasty. Musk is suing Altman, accusing the company of abandoning its original nonprofit mission in favor of commercial interests. OpenAI has pushed back, calling the claims baseless, and says Musk is simply trying to slow a competitor. The case is expected to spotlight how AI is governed and commercialized as the technology plays a growing role in the global economy. And just a quick look at the markets right now. Off slightly, TSX by 0.3. South of the border, red there as well. And in about that same ballpark, S&P 500 up by 0.17, Dow Jones 0.32, and the NASDAQ about the same. All right, Shell has announced it is acquiring Canada's ARC Resources in a deal valued at $22 billion, including assumed debt. Its biggest deal in more than a decade. This comes as Shell moves to lock in long-term oil and gas supplies and support output at LNG Canada. For more on the deal, we're joined by John Stevenson, oil and gas analyst, Granite Point Research. John, thanks as always for joining us.
Oh, my pleasure.
Who's this a good deal for? Everybody?
I think everybody, actually. It's kind of a win-win. Look, Shell had to do something. I think it had to acquire something or find something big. And so they decided to acquire something. And they got it at a bit of a discount because ARC had struggled a little bit with, it's a Tachi project, not working out quite as well as it had hoped. So it was a little weaker when it came in opportunistically, but it's a good deal for Montney producers. It's a good deal for Shell. Shell has a very low reserve life. In fact, all of the European super majors do, because they've invested so heavily in these renewables, these clean energy projects, and unfortunately the returns just haven't been there. So they had to do something. Their reserve life indice is well below 10 years. So essentially,
I think you had in your notes 5.3.
5.3.
How low is that?
Very. It's exceptionally low. I mean, now ARC is up around 9 years. But, essentially, if they just kept producing at that same rate without any new discoveries, they would be out essentially in 5.3 years. That's what that, statistic means.
Yeah.
So that's obviously a big problem for a multiple billion-dollar company, several $100 billion market cap company. So they had to do something, and this was it. And, it really highlights the area. It highlights their investment, their 40% stake in LNG Canada. So those are all the reasons to do it. Of the Montney producers, ARC was one of the more heavily weighted towards liquids. So, oil and condensate, and that helps. And that was basically 70% of their economics. So they get the gas, which is the majority, but they still get a fair heavily weighting in liquids, and that's really helpful for their economics. It boosts their production growth from a CAGR, or compound annual growth rate, of roughly 1% to around 4%. So it's for Shell. So this is helpful for them, and it also helps with their reserve life. So all of these things are pluses for Shell. And for ARC, well, they get nicely rewarded. Their shareholders get rewarded. But unfortunately, this is
27%, I think.
Yeah, so that's a good over the VWAP for the last 30 days. So that's attractive. It's a shame to see a great Canadian producer go. I guess that's probably the one caveat to it. But it certainly puts a bid under and a tailwind. And it's been part of a theme we've seen for some time, which is the majors trying to find oil and gas anywhere, and big finds. A lot of it's going offshore, and particularly offshore Africa. They're finding a lot there. That's attractive. But they're also looking, and one of the things that's been happening in our oil patch has been consolidation. It's been a constant theme.
So what do you see Shell doing with this? Are they going to grow it? Are they going to keep it where it is?
Oh, they're going to grow it. They're going to try and grow it. Yeah, they're going to try and get another 100,000 barrels of oil equivalent a day.
How much is it putting out?
370,000 BOEs a day. I think in the last quarter it was 374. It was a record. So they've done really well. And I mean, it's a significant producer within the context of Canada. And to give you some context, Shell itself is roughly 2 billion prior to the transaction. Was roughly 2 billion or 2.1 billion barrels of oil equivalent a day. So it's an adder of about 15, call it roughly 16% for them in terms of production. So significant.
And is this a good time? Is this a good time for them to be buying with everything that's unfolding in the Middle East?
I think it's a great time. I mean, because if you think about what's happening in the Middle East, essentially 20% of the oil and gas in the world of the production is offline. And even if it got back online tomorrow, what would that mean? Well, that would mean that you're still going to have a risk premium in the commodity, and you're going to have the uncertainty, and you're likely going to have the Iranians in charge of the Strait, which because of geography, they're going to be. And that means that this could happen at any time, which would, essentially turn around. Like at the end of last year, the whole narrative in terms of oil and gas was, in terms of oil rather, it was that we have a surplus of a couple million barrels a day of oil because we have excess production. Well, now that's been
not anymore.
Not anymore. And we're not going back to $57 oil. We might be going back to $85 oil, but we're not going back to $57 oil. So, it makes it more imperative to find oil elsewhere, and the safer the geography, the better.
Do you think we're going to see more of these M&As?
Absolutely. We're going to continue. We're going to see more M&A, and we're going to see more discoveries, and we're going to see more stuff coming out of offshore Africa, because that seems to be the geological analog of South America, where you've got these big discoveries in Guyana and places like Brazil. And so I think you'll see more of that.
And now with Canada, does it look more tempting as a stable, safe place to be doing this?
Well, it does. And the reason Canada is so attractive is you've got these very, very long reserve lives. If you look at the U.S., of course, the U.S. is now the largest producer in the world of oil and gas, but it's shale. And a lot of that is starting to essentially hit its peak production and start to slowly decline. So you're going to see that peak production hit either later this year or in next year. And so, its prospects look relatively less good. whereas Canada, even though it produces significantly less than the U.S., still has these massive reserves. And so I think you're going to see more and more activity directed in Canada, as it should.
And with the LNG, that's a big part of it. And that's the other thing with the Gulf, too. I mean, we lost 20% with Qatar, about 20% of LNG production.
Well, it's been huge. We've had a huge hit with LNG coming out of the Gulf with Qatar offline. And in some cases, the Ras Al Khaimah plant, which is the largest liquefaction plant in the world, is going to be off anywhere from 3 to 5 years. I mean, that's they just it's crazy numbers, and it just shows how complicated and integrated the whole system is, and sophisticated it is, and how difficult it can be to get production back up when you've had that. I mean, these plants were never designed to be, withstand war or acts of aggression like this. They were just meant to produce the commodity and do that efficiently. So,
and do you think we'll see that growing here in Canada, then, the LNG?
It has to. Because you look at the prices, you hit $20 a 1,000 cubic feet in Europe, where it's trading at now here, $250, something like that. So, I mean, it's a huge prize. And of course, a lot of that gas and oil from the Mideast went to Asia, 80% roughly. So you're going to see more and more stuff happening in Canada in oil and gas because we are that safe producer.
Okay, we've got to wrap it up there, John, but always a pleasure. Thank you, sir, for coming in.
Thank you.
That was John Stevenson, oil and gas analyst at Granite Point Research. Coming up, fuel prices are surging, of course, with the Strait of Hormuz remaining closed. After the break, we'll see where the next wave of energy investment is headed. Rising fuel prices driven by the ongoing closure of the Strait of Hormuz are speeding up investment in energy infrastructure. Now, earlier, Bloomberg spoke with Olivia Wassenaar, the head of Apollo Infrastructure Group, who says the focus is on strengthening energy networks in the Middle East and expanding global investment across pipelines, LNG, and power. Here's more of that conversation.
I think we're all looking at a few things. We're looking at redundancy, right? We're looking at the current infrastructure in the Middle East and maybe where there are gaps, right? You're looking at things around existing pipelines. How do we max out existing pipelines? How do we think about where there's potential for new pipelines? Can you restart old pipelines? People are beginning to talk about things like rail again. So I do think in the Middle East, there's this real focus on redundancy. In the rest of the world, we're looking at where can we compensate. We announced a deal last week for a large Canadian gas infrastructure platform. We believe Canada is a really attractive market right now, especially if you look at what's going on with Canada LNG and access to Europe, access to Asia, really sort of a big part of the broader sort of value chain there. So we are very actively investing in other parts of the energy infrastructure globally.
Well, let's go through the global backdrop and the deals right now. You mentioned Canada. We had EDF over in the UK, RWE in Germany, offshore wind, Ørsted, I believe, as well. I don't want you to pick a favourite baby, but right now, is there a theme that really gets your interest out of all of those right now, of those deals that you think are the ones to watch?
We've really been investing heavily in Europe. We do see this theme around making sure we're giving, again, real redundancy and growth in European power infrastructure. So we started RWE around the grid. We looked at EDF around nuclear. And now we're really focused on offshore wind with the Ørsted deal. I mean, this is a tremendous project. If you look at the number of homes it's going to power across the UK, it's really tremendous. And we're also thinking a little bit about, how do you give really reliable long-term power to supply to areas that have previously been really dependent on oil and gas from places like Russia and the Middle East.
You have a great lens because in having these discussions and these investments, you have to work with policymakers pretty closely to understand exactly what their appetite is and getting clearance, et cetera, and permitting. Have you noticed a change when it comes to Europe in particular as they try to accelerate some of their reliability, given the supply shocks that have come to them from all angles over the past couple of years?
Absolutely. I mean, we saw sort of the first start of this in 2022 around the Ukraine crisis, right? And that was the first time you saw sort of a pan-European focus on, okay, how do we make sure we're really more prepared longer term? Now with what's going on in the Middle East, you had a big announcement out of Europe last week saying we've got to focus on two things. One, short term around how do we really help the consumers? And then long term around how do we look at better permitting, faster permitting? How do we speed up electrification? How do we speed up things like batteries, which are going to help smooth out intermittency, right? So there's really such a big focus within Europe on how do we make sure that we're taking this reliance away from other areas of the world.
The fact that everybody wants to build at the same time makes things a bit complicated. How much are you experiencing shortages of things like turbines and engines and the actual pipes and things of that nature, given the fact that everyone is trying to do this at the same time at a time of potential supply chain constraints because of the Strait of Hormuz being blocked?
Absolutely. I mean, it's a real issue, and it's something that we're all grappling with. If in the U.S., for example, if you do not have your sort of components around a new gas plant supplied, you're looking at 5 years, right? That's a long period of time to get to really get the new components in place. So this supply chain is just compounding. And when we look at what we're going to see around the rebuild in the Middle East, whenever this conflict is over, that is only going to add to the need for some of these components.
Every single Middle East country is coming out now basically saying we want what the Saudis have. We want an east-west pipeline. We want to be able to bypass the Strait of Hormuz. Can you get the appetite for that kind of investment when Iran and the IRG still remain a threat?
I do think you're going to need to see some stability, but you saw it out of the EU last week saying, hey, how can we help with investment in the region to really, again, help this redundancy piece? When you look at pipelines, that's helpful for crude, but when you look at things like refined products, like jet fuel, for example, and LNG, these are things that are not going through pipelines. So we need to think of other ways to be able to transport these and really ensure that security.
To get that confidence, though, it's not even just for oil and gas. There's all this money put to data centers, and people now are talking about them having to go underground. Do you still see the optimism for people wanting to be invested heavily in this region?
I do. And the offer on the data center side was very clear for a while, right? I mean, if you look at it, there was cheap power in the Middle East. There was abundance of land. There was lots of local capital, and for many years, this sort of real perceived political stability. You've sort of taken the last point of that off. I do think you still see the other components there, but there is going to be a little bit of confidence coming back to the region before you see people really wanting to reinvest in this AI phenomenon.
You don't have to worry too much about the political cycle in certain parts of the Middle East, and that's a different conversation. With Europe, maybe you do, and with the US as well. How relevant is the political cycle to some of these decisions?
You see it a lot around, for example, renewable energy, right? And we've certainly seen, I mean, I've been investing in renewable energy for 25 years. You've seen real sort of booms and busts over time. What I will say is it begins to be tied more into security than it ever has before. I mean, again, as we look at Europe, right, this sort of dependency, whether it's on Russia or on the Middle East, and all of a sudden looking and saying, what can we do internally? What resources do we have? We have sun, we have wind, right? These are things that we continue to build up internally. We can look at electrification. So we're, again, less reliant on these commodities coming from other parts of the world.
Do you think there is a bigger focus now on abundance? I just wonder to what extent the conversation really has changed. Lisa mentioned that. It seems to me that everything's become very polarized, that for certain political groups, particularly in Europe, they believe everything that is fossil fuels or touches fossil fuels is bad, and everything that's renewable is fantastic under any situation, in any circumstance. And for whatever reason, the other side sees it completely differently. Do you think we have got some kind of moment here where we can just accept we need something from both worlds? We need abundance.
I think that's absolutely spot on. Right now, you're looking at a crisis, right? And everyone is trying to figure out how do we fix this, right? If you look at Europe, Europe has spent about $25 billion over the last few months since the war started to get the same amount of energy supply they had before. So they're looking at it saying, gosh, rather than making this highly politicized, let's figure out, again, how we can have homegrown energy supplies.
That was Olivia Wassenaar, head of Apollo Infrastructure Group. Coming up, some stocks to watch, including a storage name flying under the radar on the AI infrastructure build-out, Seagate Technology. Earlier in our On the Radar segment, where we look at stocks on Portfolio Manager's watch list, we were joined by Kyle Taylor, Wealth Advisor and Portfolio Manager at Tri-Delta Private Wealth, to talk about several concepts, several ideas, including Seagate technology, which is gaining momentum amid an AI-driven storage supercycle.
It speaks to a few names that we own, and it's all about the AI enablers and who they are. Seagate Technology is a mass storage company that has been integral, maybe flown a bit more under the radar in regards to the AI infrastructure buildup. And they really only have three main competitors in Western Digital as well as Toshiba. Toshiba is probably a distant third, so Western Digital and Seagate have been on a rather similar trajectory.
It's almost a moat around them.
Yeah, exactly. But it almost goes down to the fact that as the AI infrastructure and the hyperscalers are spend, and they need the resources in order to accommodate that. And Seagate, Western Digital, they've played a primary role in providing the necessary infrastructure in order to do so. And if you think about storage, it makes a lot of intuitive sense, because if you look at any of the AI models and the underlying large language models underneath them, they need to retain that info in order to improve it. And that's where Seagate comes along and has been really important in the space.
And are they incorporating? I mean, everything that we talk about, the question AI. How are they incorporating? Do they run a risk of being impacted by it negatively?
Well, if you think they're creating the underlying infrastructure, so they're in the hardware business. They're so the nuts and bolts of the AI data centers, right? So they're a necessary piece, and really there's a lot of supply constraints in Seagate and others in regards to making sure that they have the product available to actually develop these AI data centers. And that's been
an issue for a lot of companies.
But it's been a really great tailwind for a company like Seagate, because people need what they have and they don't have enough of it, and it allows them to have a little bit more pricing power in that respect as well.
All right, let's jump over to Micron.
Micron, again, is another storage company. It is the 5th largest chip maker in the world. They have a few competitors specific to some of the chips that they make, which are DRAM and NAND chips. If you think about how those work, the DRAM chip is dynamic random access memory. Without going too deep into the weeds, they actually are used in the GPUs for NVIDIA. They're used in the data centers, and them and SK, which is and Samsung, which are two South Korean companies, really have about 80% of the market share in that respect. And what I've really liked about Micron in particular, and I think analysts love this stock, is the fact that they are making an effort to sign longer-term commitments with regards to what they're supplying, which adds a lot of visibility to investors in terms of long-term profitability. They're facing similar supply constraints in that they're not able to fulfill the total orders that are coming in. And although I think their product, many people equate to a commodity adjacent product, it's something that is necessary in this buildup, and they're certainly benefiting as the chip makers have benefited.
And we've had a few people on talking about quantum computing. What kind of a factor? I know it's not there yet, but when it does get there, are you looking at that and seeing what the interplay that might have with it?
Well, I think when you speak to the actual management teams of these businesses, they're all very opportunistic, and they speak to each other very regularly, especially if you're a supplier to the infrastructure that's being built. You know what's around the corner, and they're constantly looking to develop that space and be an integral player not only in 2026 and 2027, but into the 2030s.
Yeah. So I know they're aware of it, but yeah, quantum computing is a fascinating next step, which I think may make AI almost look, dull.
Could be around the corner.
Okay, MKS, the third one.
MKS really is the supplier of suppliers. They actually create the equipment and the tools and the components that then the chip makers would then use to manufacture the chips themselves. They have this strategy, they call it the surround the wafer strategy. So their entire mandate is to make themselves integral in the chip makers and what they're doing. And obviously they've benefited quite a bit in regards to what's going on around them in the AI space and the AI mindset that's driving stocks higher in regards to April in particular. What I've liked about them in particular is their management team has shown a lot of prudence. They've made strengthening their balance sheet a primary objective for them. They're actually paying off $100 million of debt quarterly.
Wow. Okay.
In order to allow them.
How much is their debt?
They reduced their net interest expense about 25% just in 2025. So it's significantly come down, and it's become less of a factor for the stock itself. But I think from a prudence perspective, it makes a lot of sense, because if the AI supercycle boom doesn't work out as people maybe expect, it allows them a lot more flexibility to kind of navigate that rather than having this kind of debt burden overhanging them.
And that was Kyle Taylor, wealth advisor and portfolio manager at Tri-Delta Private Wealth. Let's take a look at the markets, see how they are shaping up on this Monday. And right now, TSX actually has been slipping through the hour. It's off by about 0.4%. And south of the border, the uncertainty in the Middle East weighing there as well. And you can see they are all in the red. The S&P 500 up by 0.14, the Dow by about 0.27, and the NASDAQ by 0.29. A couple of stories we're following. News with Microsoft and OpenAI that they're ending their exclusive AI pact. You can see Microsoft is down slightly on the news. It would simplify their complicated relationship, is how they describe it, and allow OpenAI to pursue deals with cloud computing rivals like Amazon. So that brings in some competition. And another tech story we're following right now is that Poet Technologies, they are down 6-7% on the news that Marvel, which bought Celestial AI, has canceled all their contracts because of violations when it came to confidentialities, possible breaches there. Market Call is coming up next, and Richard Fogler will be on with us. He's the managing director at King West, and we'll be taking your questions on North American equities. That's it for Morning Markets. Thanks for joining us. We'll see you back here tomorrow.